No matter how big or small your portfolio is, there's one simple question that every investor needs to ask themselves before they go ahead and invest a dollar. When and how much cash flow is this investment going to deliver to me, and when is that going to happen? And that's actually not how most people think about investing. They think about a total return number or increasing your net worth. But the reality is that we're all investing for cash flow at some point. We need that money to come back to us, and we need it to be a lot larger than the money that we're putting in. And yet very few people set up their investment portfolios for this reality. Very few individuals structure their investments to deliver cash flow. And so today I'm going to cover 4 different ways how people invest. You're probably in one of these categories. And we're going to go over the tweaks that you might want to make in order to solve for this problem. All right, let's dive in. All right, so path number 1 is the S&P 500, the stock market. This is where the majority of investors start, and many of them end here. They don't get any diversification. They have 100% of their net worth in just the stock market. Maybe they start adding some bonds as they get older to reduce their risk, but for the most part, about the overwhelming majority of investors have a giant percentage of their portfolio in just stocks. Now, that's certainly better than not having any exposure to the stock market. We certainly want a big part of our portfolio to be invested in equities, but the stock market looks a lot different than it did just 20, 30 years ago. It is highly concentrated in the Mag 7, the Magnificent 7, mostly technology stocks, and it has largely become a total return type of investment. In other words, there's not a lot of income being generated from your stock portfolio these days. The current dividend yield on the S&P 500 is about 1%, and that's as low as it's ever been. And that is an all-time low, literally, in like 150 years. That is the lowest dividend yield the stock market has had. And this makes it incredibly difficult to fund your lifestyle, to fund your retirement with just income from your stocks, obviously. If you have a $5 million portfolio, you're only generating about $50,000 in annual dividend payments from the S&P. You would need a $30 million portfolio in order to get the $300,000 or so a year many of our high net worth investors are targeting in yearly income from their portfolio. And naturally, most people do not have $30 million to invest that way. And so they end up selling shares of their portfolio in order to generate cash flow in retirement, which obviously can work, but it's not ideal for a lot of people. They don't want to have to be thinking about when should I sell. They don't want to actually go through those motions if they're traveling, if they're away from the computer. A lot of people, especially people who have invested in real estate or businesses, selling the principal down to cover their lifestyle. They've invested in real estate and lived off the cash flow. They've built businesses and taken cash flow from the business each year to fund their lifestyle and just watch that principal continue to compound. And they like to see that same dynamic from their investment portfolio. They would much rather live off the dividends or the cash flow from the portfolio, have that be on automatic coming into their account monthly versus looking at the stock market, watching the volatility and deciding, hey, do we want to sell 1% this quarter for our 4% total for the year? Do we want to sell a little bit less because the market's down? Do we want to sell a little bit more because the market's up? Sure, most people can pull that off, but it's not your retirement and your investment on autopilot, where the cash flow is coming to you regardless of the volatility in the stock market. But once again, stocks certainly deserve to be in your portfolio. They just don't deliver the cash flow that they used to. Okay, that was path number 1. What about option 2? Option 2 is the income investor, somebody who is very focused on getting cash flow from their investments each and every month, often at much higher yields than they could get by just investing in bonds, United States treasuries. And this is a path that most financial advisors never show their clients because it is very hard for them to pull off operationally. They don't have the due diligence expertise. They don't have the analytical team to pull this off. They don't even have the experience of looking at alternative income assets in order to know which ones to recommend. They would much rather put their clients into a 60-40 stock and bond portfolio that's on autopilot, which is highly profitable and very easy to run for their firm. And that is unfortunate because there is a subset of investors, an investor that really likes this concept of recurring income coming into their bank account, regardless of what they are doing each and every month, that would prefer a little bit less volatility from their portfolio and doesn't look at each investment that they make as just an IRR or total return type of investment. They don't look at each investment and say, hey, what is this going to be worth in 30 years? Instead, they look at it a little bit differently. Say, out of every $100,000 that I invest, how much of that in thousands they analyze each investment based on the yield, how much income's coming back to them for every $100,000 they're putting into a new income investment. And so somebody that only focuses on income investments might have a $5 million portfolio in real estate and debt investments that could be generating 8% yield, which if you remember, comparing that to the S&P 1% dividend yield, that was 50,000. In this scenario, it's 400,000. Now, we don't know for sure which of those two investors are going to outperform on a total return standpoint, but the income investor almost doesn't care because they're getting their needs from an income standpoint each and every month without having to stress as much about the headlines in the newspapers, wars, economic policy, tax policy, and how that's going to affect their ultimate portfolio. They're mostly, once again, just focused on getting that cash flow each and every month, hopefully from investments that are more defensive in nature because they're focused on getting that income as opposed to trying to hit very high total returns. Now, important caveat here, this strategy is not without its own risks. Of course, you can have investments that stop paying their distributions. Every investment involves risk. So what's really critical with an income-focused strategy, like Path 2 here, is finding the right managers, finding the right funds that are diversified across different sectors, across a couple asset classes. So you don't have just 100% exposure to one sponsor, one fund, one style of investing. You want to diversify those income streams. So manager selection becomes extremely important in the private markets when you're focused on income. And there's a lot of factors that go into that. There's a lot of due diligence and analysis that needs to happen on the front end. You can't just look at a list of possible investments and go with the highest yielding ones. Oftentimes you can fall into what's called a yield trap, something that has a very high yield that looks really compelling, but perhaps they're taking a lot of risk to generate those types of returns. So you have to dig in deep to find the managers and strategies and generate above average income yields without taking on excessive risk to get those income returns. Okay, moving on to Path 3, we're going to talk about a real estate investor, somebody who's only investing actively in real estate to generate both income from the rents that are coming in and hopefully meaningful appreciation above that end. And this has been a popular path because real estate has generated a ton of wealth. It's a great asset class. You can use leverage or debt to magnify your returns. Oftentimes, real estate has tremendous tax benefits. And so real estate's a great asset class. But the problem is, are you doing this actively where you're the one managing the properties yourself or overseeing the property management team? How involved are you in the day-to-day management of these properties? Because, of course, as you get older, that will become more of a headache. You need to adjust your total returns by the number of hassles that you're going to have to be dealing with to maintain these properties, especially true if they're residential properties and you have tenants. It has more headaches that pop up in terms of just the wear and tear of people living in these units. Appliances break, leaks happen, things just pop up. Somebody's got to deal with those problems, which might be fine if you're still in the growth phase of your career, you're a bit younger, but as you get over 60, you're probably not going to be wanting to field tenant calls, maintenance calls at one of your properties. One of them is if you're traveling overseas and there's a big problem. You tend to want to simplify things with your investments as you age. And this is one of those asset classes that tends to not simplify over time. A lot of our investors are current or former real estate investors that are either looking to simplify their lives or are looking to sell their portfolio down and then replace the income that they've had and then take the profits from those sales and invest them in other income producing assets that are more passive in nature. All right, on to Path 4. This is an entrepreneur, somebody who's managing the day-to-day operations of a business. This could be in any industry or it could be a startup. Now, this is the most leveraged path you can take. And I don't mean that by putting debt on the business. What I mean is the amount of actually profits and net worth that you can grow over time by running a successful business blows away just about anything else you can do in investing. Because if you can build a business that's generating millions of dollars of cash flow or earnings, you can often go out and sell that business for 5, 10, 20, even higher $1 million and generate just an amazing amount of net worth for you and your family. Of course, this is also the highest risk path. The overwhelming majority of businesses do not even earn enough cash to pay the owner of the business a reasonable salary. They are subsidizing the business with their sweat equity, with their work. But when this does work, it's incredibly powerful because profitable businesses can generate tremendous cash flow that you can either pull out of the business as a distribution, or you can reinvest it back into the business. You can hire more people to grow your top line revenues. There's just a lot of options to really start magnifying your wealth when it does work. But things happen. And so what we do see from time to time is business owners that have just not diversified. They have their entire income, their entire net worth in this one operating business, which is going great at that time, generating cash flow for them and their family. But that is like investing 100% of your stock portfolio in one stock. That is extreme concentration of your net worth. And so with these business owners, we like to diversify their income streams by starting to allocate some of their profit from the business into income producing asset classes that are generating wealth outside of their day-to-day operations. And it's amazing how much stress that can relieve as they see the passive income streams start to build up over time, with the goal of someday having that passive income match their active income from their business. Okay, so that was 4 different paths, and I actually don't have problems with any of those paths. What I do like to see, though, is having multiple paths. I like to see 2 or 3 of those paths being implemented at the same time, so you have some level of diversification with your net worth and the income that's coming into your household. Because when you have multiple paths, not only are you focusing on the day-to-day cash flow needs of your household, but you're also growing your net worth over time to outpace inflation. And then if you can layer on some tax strategy in addition to that, then you have this coordinated approach that's going to maximize the after-tax net worth of your family and the amount of income that's coming to you each and every year. And so if you're at the point where you only have one of these paths, or you have multiple, but you have no coordinated strategy that's working across asset classes, feel free to reach out to Evergreen Capital. There are resources below. You can go ahead and apply to set up a call to talk about your specific investment portfolio. All right, thanks for watching.